Welcome back to Johnson Consulting Conversations, where we talk with people who are shaping the future of funeral service and death care. Before we get started, a big thank you to you, Maddie, for that warm introduction. Maddie, we always appreciate you. Today, I'm joined by Andrew Kennedy, a senior loan officer with Live Oak Bank, where he specializes in financing for funeral homes and cemeteries. Andrew has helped funeral professionals across the country secure well over $100 million in loans. He was recently named one of ICCFA's 40 under 40 for his leadership in this space. And if you've ever wondered what lending really looks like and how to think about growth, acquisition, succession from financial standpoints, this is the conversation for you. Andrew, welcome to the show.
Thanks, Lacey. Thanks for having me. Thanks, Maddie. Thanks all at JCG. You guys are incredible. Excited to spend some time with you guys today.
Thank you. And Andrew, I'm curious, how did you find your way into the funeral home and cemetery lending world at Live Oak Bank?
So I started my career at Live Oak Bank in 2018. And at the time, I didn't know that I was entering the funeral profession, to be honest. So I don't know if you guys know or not, but Live Oak Bank, we lend to about 30 to 40 different industries. Funeral home is one of our original four, one of our healthiest, one of our largest divisions at the bank. I showed up in 2018 as a business analyst and got assigned the funeral home portfolio west of the Mississippi. So I spent my first year or so kind of servicing and helping our existing customers grow, look at financials, talk about what's next. Here I am today, 7 years from that date, 8 years total, the senior lender on the funeral home team. I never thought I would be in this industry, but I'm thankful each and every day that I am. I love what I do. I love getting creative. I love talking loans. I love learning people's goals and their visions and doing everything I can to assist them with their goals. So happy to be at Live Oak Bank. Very happy to be in this profession, 8 years now, and hopefully along many, many more years to come.
Well, we are certainly thankful to have you in this profession, and that is a great window into how you got here. It also raises the question of what we hear often. Why does the death care profession warrant its own dedicated lending specialty?
So I've quickly learned that funeral homes are not like any other small businesses.
Mm.
Every small business has its own operating model, and the death care especially does when you think about various revenue streams, pre-need obligations, the licensing requirements, and more. Those are things that a commercial lender typically doesn't know or doesn't care to learn, frankly. We know that time is valuable. So 15 years ago, when we started lending to funeral home professionals all across the country, we realized that meeting the customer where they are, speaking the language, not having to spend time learning what a retort is, what a call is, the different kinds of services, what pre-need is, right? We're in the language, we speak it, we're talking to the right people each and every day. So it's a huge time saver, and it's been well received by the individuals and the groups that are looking for financing when, you know, you meet them where they are. They're not having to spend time backpedaling, trying to share with you the ins and outs of this profession.
And that specialization clearly shapes how you look at a deal. And let's dig into that a little bit more from a lender's seat. What makes funeral homes and cemeteries distinctive compared to the other businesses that you could finance?
Well, I think right out of the gate, one of the biggest differences is how stable this business is. When you think about a cemetery business or a funeral home business, in a way, it's really bulletproof, meaning that it's very stable, it's very consistent. You know, we all know and recognize that unfortunately our time will come at some point and we will pass away. Um, and families want to ensure that their loved ones are well, taken care of, and that, you know, anyone that's taking a leap of faith into funeral home ownership, this is a rewarding investment for them. And another thing too, to kind of point out, demand doesn't fluctuate with the economy like many other businesses do, right? That goes back to the comment on people are going to pass away. People want to, cherish the memories and show support and love for their family member that just passed.
That's very helpful context for owners who may not realize how differently their business is evaluated. What do you wish more owners understood about how a bank views their business?
That's a great question. I would say that I wish that more owners understood that we're not looking for perfection as a bank. We're really looking for predictability, right? When you think about revenues, when you think about profit, consistency, banks don't make lending decisions typically just on 1 year or one slow year. I just talked about how the business is very stable, which it is, but we also know each quarter, each month can be cyclical. It comes and flows. Year revenues are typically very consistent in the space, but quarters, months can be cyclical. So there'll be busy months and slower months. We're just trying to understand the full story of the business. And doing such, we're typically reviewing consistency or looking for consistency. We're analyzing cash flow. We're looking at the management for the staff currently and after the change in ownership, the business reputation in the community, and more when looking at funeral home businesses.
I want us to get practical for a moment because I know that our listeners are probably eager to get down to the nuts and bolts of it all. And what are the main ways an owner can finance a funeral home today?
There are many great ways, and I'll do my best to go deep enough to give some good insight here, but really just kind of want to take the main takeaway for this question really to be there's different options, and there's different options for wherever you are today and what your goals are. I think the awareness of knowing what's available is important. Don't expect you to become the expert just after one quick listen to this podcast, but having enough to know what's available and then having the option to talk with me or someone else that knows the different options. So real quickly, SBA loans is a great option. We'll spend a couple minutes, I'm sure, talking further in the weeds with SBA financing. Conventional bank financing is another viable option. Seller financing is another way to buy a funeral home business. There's also private equity. And in many occasions, it's actually a combination of all of these, or at least a couple of these sources working together. So whether you're a buyer or seller, the takeaway here is that there are options for you, and there are different options depending on where you are and what your goals are. The sooner you can have a conversation, the better equipped you will be for your options.
So I want to talk a little bit about SBA, which you've already mentioned, and that does come up constantly in these types of conversations, and there can be a lot of confusion around it. What is the biggest misconception that people have about SBA lending?
Well, there's many. So we'll start with probably the main one, and then maybe we'll touch on a few more. I would say the biggest misconception about the SBA product as a whole is that people think that it's only for businesses that can't qualify for other financing vehicles. And that's actually not true. Some of the strongest funeral home operators that we work with and in the country use SBA financing because it often offers longer repayment terms and allows them to preserve cash flow for future growth. A lot of people are wanting to grow. There's a lot of M&A activity out here going on right now in the space. And if you can, borrow money and keep cash flow strong while also preserving your balance sheet, that's really attractive to a lot of people. So SBA financing is often a strategic financing tool. Other misconceptions are that it takes a long time. Well, I would say that's partly true, and I'll dig deeper into that here. So when it comes to SBA financing, you're really working with an SBA lender that has to process one of two ways. Simply put, there's general processing and preferred lender processing. Basically, what that is, if you're working with a bank that is GP, they do not have preferred lender status. So anytime that they are structuring an SBA deal, they have to structure the deal, internally approve it, and send it to the SBA administration in Washington, D.C., and wait for their stamp of approval, which can typically, as we know, can take quite a bit of time for the government to review and make decisions. So with a preferred lender status, we're working with an SBA bank that does have preferred lender status. They typically can move about 4 to 8 weeks quicker because they can approve, close, and disperse the funds in-house. So Live Oak Bank, for instance, we are a preferred lender status. We're the largest SBA lender in the country. There's other banks that also may have preferred lender status, but there's a huge difference in working with someone that maybe their bread and butter is SBA financing versus someone that's trying to learn SBA financing on the fly. And typically it's felt from the buyer's perspective or the borrower's perspective because you can see who knows what they're talking about, frankly, and who doesn't, and also just the amount of time it takes. So it can be a little bit more strenuous from a time sake standpoint, but working with the right lender and one that has preferred lender status, that's a big misconception. Others, others is just the amount of paperwork that comes with it. I would say that that's a misconception. There have been people that have applied for an SBA loan in the past and have refused to try it again. Well, like many things in life, things have become more efficient. SBA paperwork has as well. And again, just to kind of round out that conversation, many of our strongest borrowers use SBA financing today because it's the best financing option available to them and their business.
For anyone that's weighing their options, can you explain the main differences between the SBA loan and a conventional loan to maybe someone who's looking to decide between them?
Yeah, absolutely. And again, just to kind of echo my last comment, it's difficult to get too far into the weeds on on a podcast, but happy to kind of explain kind of what the differences are. And of course, any questions, any further conversations, would love to chat on that just so you know where your options are and can evaluate making sure that you and your business are making the right decision. So since we just talked about SBA, we'll talk about conventional first, and then we'll kind of answer the SBA side of things. So with conventional financing, it's typically more restrictive, meaning that there's going to be covenants, whereas SBA financing does not have covenants. With conventional financing, you're typically going to see larger down payments. You're going to see shorter amortization because oftentimes conventional financing is a little bit riskier for the bank or the lender. You're also going to see lower leverages, which means higher debt service coverage ratio requirements as well. Shifting gears, looking on the other ends of things, SBA financing, you're typically going to see longer terms. As I mentioned before, there are no covenants with SBA financing. SBA financing typically has lower equity requirements. We'll talk about it here, I'm sure, soon, but there's ways to qualify for 100% financing if that's something that you're interested in. Oftentimes, it's more flexible with the use of proceeds, meaning you can include acquisition capital, the purchase of real estate and business goodwill, renovation capital, equipment capital, working capital, all in one loan, which a lot of people find to be attractive. It also preserves cash, right? As I mentioned before, if you don't have to bring as much cash to the table and you can get a longer loan term, longer amortization, your cash flow is typically going to be stronger.
So when we're thinking about a SBA loan, what makes the most sense for a funeral home owner, given those differences that you just pointed out?
Yeah, so as I just mentioned, one thing that I want to kind of restate is that SBA financing, one thing that's nice about it is how multi-purpose it is. Again, you have the ability to do a lot of different things within one loan, which it's nice only having one payment to the bank. It can also save money in closing costs, loan fees, etc. Again, I mentioned the example before of including renovation capital, equipment, with an acquisition purchase. That's very popular. I can't tell you how many times just this year I've helped someone buy a business and that business that they were buying did not come with a retort, but they wanted to include one. That's one nice thing about the SBA is it'll, help with alleviate some unnecessary expenses, but also open doors for future revenue streams as well. So other examples of when it makes sense to utilize an SBA loan is when you're buying your first business, as it's most attractive from a money down standpoint. Again, you can buy your first business with anywhere from 5 to 10% down, depending on if the seller is willing to help bridge that requirement with the seller note, which we'll talk a little bit more in depthly about. The SBA is also a great way to expand by way of acquisition. Another option is if you are an existing business owner that is looking to penetrate a new market or build a new facility. The SBA also provides construction capital as well. Other options, buying real estate, partner buyouts, succession planning, refinancing of debt. It's a great product for an individual or business that's looking to preserve liquidity. I often think and hear all the time from borrowers and people that I'm working with that cash is instrumental for the business. Many business owners view cash as king. So SBA financing often lets owners keep most of their cash in their pocket, which most people find very attractive.
Now, a lot of owners, they're sitting on debt that was taken out years ago under very different conditions. When does it make sense to refinance?
Great question. I think it's always healthy to be thinking about refinancing options, especially when it makes sense. And if you don't know when it makes sense, let's have a conversation and making sure that it makes sense from, where the economy is at that time, making sure that you're out of prepayment penalty windows, et cetera. Reasons for refinancing besides the obvious, which is, an interest rate reduction. Other options or reasons for refinancing could be monthly payment reductions from a monthly standpoint, improving your cash flow, extending amortizations where you can focus on paying more down towards principal each month, also consolidating debt. So I would say those are probably, the quick and easy high level answers to when it makes sense to refinance. Again, I get calls all the time and welcome them with open arms. Hey, should I be thinking about refinancing? Is now the right time? Let's have a conversation. If it makes sense, let's do it. If not, let's be strategic in making sure that we're finding the right time to refinance that debt.
And when you're talking about refinancing, talking about that financial health is extremely important. And looking at that business day to day, what are the most common cash flow mistakes that you see in this profession?
Well, right out of the gate, I would say poor financial reporting. It
Mm.
it kind of continues to amaze me how many people that I work with that, struggle to get their financials in order or get them over to me, whether it's, an accounting issue or some other uh, hurdle that's made it difficult. But having poor financial reporting can be difficult. Not budgeting for non-recurring expenses is another thing, right? We know that life's unfair. Life throws its curveballs to us individually and, of course, to our businesses. Making sure that you've budgeted for, non-recurring expenses and things that can come up is really important. Also, running personal expenses through the business is okay. We see that it's your business, do what you need to do. But if you're going to do that, please make sure that you're keeping track of them, right? Because lenders, banks are going to want to determine what the true cash flow is of the business, especially if you're looking at buying or selling a business, especially on the selling side, right? If you're thinking about selling, having and knowing what was considered a one-time in nature expense, what are personal expenses, having documentation for that's going to be helpful because a buyer and the buyer's bank is going to want to verify that information with supporting documentation.
I like talking about good financial habits. In addition to those, are there any others that separate the business that get approved easily from the ones that do struggle?
So a couple thoughts on that. I think strong businesses know their numbers every month, not just at tax time. I had a mentor of mine once tell me that, and that's one thing that's kind of stuck with me. And kind of on that note, if you're working with someone that, is slow to get you what you need from a financial standpoint, or, you're not quite happy with, and if you're not working with an industry-related accountant or someone specialized in this profession, highly encourage you to consider that. I think that many of the most profitable and best borrowers that I work with are that they use industry accountants and ones that understand the business, just like you guys do at JCG and just like Live Oak Bank does. Another thing, Lacey, that I'd point out is that speed matters, and who you're working with for your lending can also matter. Financial habits that allow for businesses to be approved quicker by the lender, are businesses that can provide their financials in a timely manner. They have clean bookkeeping, show consistent profit and healthy EBITDA margins. And they're just a strong communicator, right? When speed matters, you want to be working with someone, and banks want to work with someone that, can communicate effectively. That stuff matters. Speed matters when looking at opportunities and looking at deals.
I want to build on that speed and having the financials. What should an owner have in order before they ever approach a lender?
Well, this is a great opportunity for me to talk about this because, frankly, we don't see this often. So if you are an individual that can do this, that is a breath of fresh air, and that will be extremely helpful and likely lead to a better experience for the bank and for you. So that's really important. First thing first, keeping it really simple, having your goals written down so they can be communicated, right? What kind of business are you looking for? What kind of financial structures are you looking for? What's most important? Is it money in or money down that you have to bring? Is it interest rate? Is it how long the loan amortization is? What are your goals? And that can be from the financing side of things, but also what businesses you're looking for. Starting by writing down your goals is a great place to start. Things that the bank will need, just kind of rule of thumb, business tax returns for the business that you're buying. And if you are an existing business owner, we'll want to look at 3 years of business financials for your business as well. A current profit and loss and balance sheet, right? You know, if we're looking at an opportunity today, we're in Q3 now, which is hard to believe, but there's been 6 months of financial history that's taken place since 25 year end. So we'll want to get a current profit and loss and balance sheet just to make sure that we have the most accurate, most up-to-date financial information.
And we
Additionally, we'll want to see a debt schedule for the business that you currently have, just to make sure that you can afford to continue to pay your existing debts while looking at new debts. And then, of course, you know, a business plan is always helpful. It may not be required, but you can certainly wow the lender if you've kind of put some thought and, you know, organizing a business plan. And then a purchase agreement or letter of intent. It's always great if there's already a letter of intent, price, seller financing, if a part of the deal, all of that's kind of communicated early. But that's not always the case, and that's perfectly fine. There are many examples of when, you know, a buyer reaches out and says, "Hey, I'm looking to, you know, evaluate an opportunity. Can you help me determine, you know, what the cash flow can support in terms of future debt?" That's great. If that's you, we see that often. You're likely not going to have an LOI in place yet. You may need a little extra guidance. We'd be happy to help and support in that way.
That is an awesome checklist or to-do list. We will have that in that form on the recap blog post. That was great information, Andrew. And we know that death care has some financial structures that other industries simply don't deal with, and that's pre-need. How do the pre-need trust structures factor into how you evaluate a funeral home's financial health?
Good question, and one that we get often, Lacey. So, pre-need is an important part of the funeral home business. I think everybody listening can attest to that. It's very important. However, from a bank's perspective, it's really more of an indication of future market share. So, in our eyes, it helps us evaluate the long-term health of the business, right? We aren't exactly sure when that pre-need will become at need. You know, it could also vary and transfer from one funeral home to another. So it's a really good indicator for the reputation that the business may have in their community, what they're doing to plan for the future. So it's very relevant from a future market share standpoint, but from a lender slash bank's perspective, you know, it's more about cash flow than pre-need, but pre-need is certainly relevant and an important um, part of the business.
I want to go deep on something that you have briefly mentioned, which was the books that funeral homes keep. Some are a little bit more diligent than others. For an owner whose books aren't what they need to be, what's the first thing that they should fix?
Well, having accurate and timely financials is most important, right? I think if you can't make a good business decision, you can't really expect a lender to. So if you don't have clear picture on how your business is performing, that's likely something that you need to try to correct as quickly as possible. I think many of the best funeral home owners out there are looking at their books constantly. They may not be the, you know, the bookkeeper or an accountant, but they at least know what's going on and well aware on each business decision they make, how that can impact their numbers. And, you know, I think a lot of times, you know, you've got to build the right team in place, and that usually starts with having the right CPA, having a knowledgeable bookkeeper, and one that can produce financial statements that you can trust and that a lender can trust. I kind of another thought on that is I don't think perfect books are necessarily a requirement, but I think reliable financial keeping should be.
I want us to move into growth because those owners that do have the books in place, they've got a great team in place, they are looking and thinking about what is next. How should an owner really think about financing the purchase of a second or third location?
Well, it's never too early to be thinking about what's next, and I've got a lot to talk about with that. But for focusing in on this specific question, I think the first thing to review is the health of your current business. What do your trends look like? Are you cash flow positive? Have you been able to pay debts back as agreed? That's really important. That's, I think, the first thing the bank will look at is to making sure that this business, it's a good indication for what future businesses will look like when you're an existing owner and we can evaluate the health of your current business. So understanding, where you are today, and if you're not quite happy or you're working on things, there's no time like the future for that. If the answer is yes to all these, my business is good, my financials are organized, clean, I've paid debts back, have a healthy debt service coverage ratio, that's great. You're certainly in the driver's seat for additional capital and ready to expand if that's something that you want to do. Um, Growing through acquisition is a great way to grow. While thinking about growth, it's important to think about staff integration. It's also important to think about maintaining the service quality that your business currently has. That's really important. And also what the cash flow will look like with a new business and future debt. Of course, banks want to make sure that what they are financing can support its own debt, first and foremost, that it can stand on its own two legs. But additionally, they also want to look at the combined enterprise and making sure that the consolidated cash flow, consolidated debt continues to show great profit, and going to allow you to continue to grow, pay debt down, put back into your business, and just do everything else that's a goal of yours as a business owner.
With acquisitions specifically, we know at Johnson Consulting Group that timing and judgment matter enormously. What tells you an acquisition is a smart move rather than a risky one?
Great question. So to simply answer this one, I would really categorize, this into four simple things or strategies, things to look for that the bank will also look for. Is it a strategic fit? Is this a business that, is like-minded to yours? Is it similar in volume? Does it check kind of the box of what kind of business you're looking for? Does it make sense from a strategic standpoint? I think is a great first way to look at it. Second, what does the staff management team look like for the business that you're looking to buy? All the listeners on here know that the biggest challenge right now in the industry, or one of the biggest challenges, is the lack of help, quality help for a licensed funeral director in Balmer. If you have an opportunity that has a great team in place and you have a great team and what you're buying has a great team that comes with a quality staff and one that knows the community, knows its clientele well, that is a wonderful opportunity and one I would be diving headfirst into. Another thing to look for when looking at acquisitions is looking at the cash flow. Does it have strong cash flow? Does it have predictable cash flow? Is it consistent? And lastly, a purchase price that supports the cash flow. That's really important. I know you guys do a great work with that. We always look at opportunities as well to making sure that, the amount that's being borrowed can be easily supported by the historical and the existing cash flow. So I would say that those are the four simple things, that kind of separate a smart decision versus a risky one.
Let's talk numbers for a minute. I want to know how much capital should an owner realistically expect to bring to the table in an acquisition?
Every acquisition, every transaction is different, truthfully, but we can speak to general terms as I think that would be very helpful for all the listeners on the call. Generally speaking, a first-time buyer, so someone that does not have ownership in a business today, but is ready to take that leap of faith into ownership, with an SBA loan, which is the more favorable product from a money down standpoint for a first-time buyer specifically, they can expect to bring 10% of the total project cost to the table. So that's for a first-time buyer. However, if the seller is agreeable to holding a seller note subordinate to the bank debt, they can hold half of that 10% on standby. So if you're a first-time buyer, you can expect to bring 5 to 10% cash to the table, depending on, the seller's agreements to help you with that. What's nice is if you are an existing business owner, and you are looking to buy another business, with an SBA loan, you can qualify for 100% financing if the ownership is being mirrored.
Mm.
So let's say that, Lacey, you own a funeral home today and you are looking to go from 1 to 2 locations, so buying a second business. If you are the 100% owner today and you will remain or be the 100% owner for the future business, you're eligible for 100% financing. Now, if you decide that I want to bring a little capital in, I don't like debt, I don't want to borrow the least amount of as possible, that's great. We would gladly take the cash that you want to put in, but you don't have to bring anything in if you're an existing owner and what you're buying can be supported by the current cash flow. For conventional deals, you can expect a little bit more cash down, as oftentimes our transactions and many of the M&As that are going on right now, you're going to see a lot of goodwill paired with the real estate. So you can expect high level, maybe anywhere from 15 to 30% when you're utilizing a conventional product, depending on, the specific assets and how they're valued by business appraisals and real estate appraisals. So high level, if you're looking for 100% financing and as a business owner, and you are a business owner today, that is available to you. If you are looking to buy your first business, there's ways for you to do that with as little as 5% down. If you are eligible or able or seeking conventional financing, you can do that. It's typically just going to be a little bit more, but hard to pinpoint without having a live or specific example to evaluate.
Beyond the acquisition itself, there's a transition period to think about. How does the financing factor into a smooth ownership transition?
Well, good financing creates flexibility and hopefully aligns buyer and seller goals. So if there's healthy communication between buyer and seller, there should be an understanding on what each party's goals are. For instance, what will the seller's involvement be after the sale, right? Some sellers like to, move from Massachusetts to Florida for retirement. Some like to hang out at the facility because they've put all their sweat, tears, everything into it, and they want to stick around and be a consultant for a period of time. Understanding what the buyer's preferences are, what the seller's preferences are, that can lead to a much smoother ownership structure. I think the big takeaway here is, the better the communication, there's no such thing as over communicating. The sooner this can be communicated regarding buyer preferences, seller preferences, the smoother the ownership transition will be.
And that is especially relevant for family-owned firms thinking long-term. For an owner that is planning to sell or pass the business to a next generation, what should they be doing financially 3 to 5 years out?
The best way for me to answer this question is to say, run your business like you are selling it today. I think every decision that you make can impact the longevity, the current cash flow, the future cash flow. As I mentioned before, life can throw us curveballs. We never know when we may have to sell. So it's very important to make sure that you feel like your business is ready to sell today if needed. So in doing such, there's no time like the future. Every decision that you make today can impact the future. So it's really important to make sure that you're running your business today like you're selling it today. Going deeper into that, making sure that you have clean financials.
That is great advice.
Reducing unnecessary expenses, right? Making sure that your profit is the best, your EBITDA numbers the best it can be. And you have time to plan for that when you start thinking about these things in advance. Invest in your business and the facility and keep track of those expenses, right? We already mentioned before how, banks and buyers will consider adjustments to the cash flow and take into consideration what you've put in. But in order to do so, we have to have that supporting documentation. So be organized, keep up with that information. Succession planning, making sure that you're working with the right team to help you, right? Whether that's bringing on a consultant that specializes in this, whether that's working with a funeral specific accountant, working with a lender that can help maybe give you an idea of what someone could get financing for. Working with the right people that speak the language can be very instrumental to the success of your sale. So I would say in summary, the best exit strategy usually starts many years before the business is actually ready for sale.
It's clear that preparation does make all the difference, and you gave us plenty of golden nuggets to think about, especially the one of run your business like you're selling it tomorrow. Now, how can the right financing be the difference between a deal that closes and one that completely falls apart?
I think a lot of times acquisitions don't fail because they're bad businesses. I think they fail because the financing wasn't planned early enough, and then therefore there was a lack of communication. A lack of communication could be on buyer expectations and desires, as we previously noted, as well as seller expectations and desires. The key theme here is to communicate with your team, to communicate with the other party. I cannot stress that enough. Specifically talking timelines. Uh, I also think that a part of that falls on the lender and the banker, right? When it's talking about realistic timelines, I think lenders should be able to communicate timelines that can be met versus kind of taking the easy road out and communicating really what the buyers and sellers want to hear. I think it's always better to underpromise and overdeliver. Everybody likes good surprises, not bad surprises. Banks included in that. And then again, just echoing this thought again, working with experienced advisors can certainly help get a deal done appropriately, quickly, and the right way.
As you know, funeral service values relationships, whether it's with community partners or with vendors and suppliers inside funeral service.
Mhm.
What should an owner look for when choosing a banking partner?
I would say a few things. First and foremost, industry expertise. I think
Mm.
that's instrumental. If you haven't figured that out by now, I think working with someone that is in the business, knows your business, knows the model is invaluable. Experience matters. How many funeral home transactions have they done? Is this their first? Is this their second? Is their third? It's usually pretty easy to see someone that knows the industry and has some experience in facilitating these deals. Are they a consistent communicator? Are they easy to reach? Right? Are they responsive? Are they willing to travel and meet you to learn your goals, learn your preferences? All of that really matters. Additionally, do they have the long-term mindset? If you're buying a business, you're probably looking at it from the long-term perspective as well. And if you're looking for not just to buy one, but multiple acquisitions in the foreseeable future, does that banking partner have the ability to provide more capital to you in the future? Right? I think that's one thing that Live Oak Bank has been really good at is helping our existing customers grow. Our portfolio is the healthiest it's been. We're working with more people than we ever have before. And that's because there's a lot of activity going on there. And we just want to make sure that we're putting the right people in the driver's seat to be successful. I think, again, from the buyer side, it's who do you trust? Who do you think can get the deal done? And again, you're just going to want to work with not just a bank, but advisors that understand this business and can see past the challenges. And frankly, working with partners in which they hear your voice. You feel valued. It's a partnership. That's really important, and one thing I'd be looking for when looking at opportunities and partners.
And Andrew, you know from experience that relationships with a lender, they are not static. They certainly evolve. How does a specialized lender's relationship with an owner evolve over the life of a business?
Well, I think ideally it becomes much more than a transaction. It's all about the long-term play. It's the long-term relationship. There have been, opportunities of which people have reached out to me to help look at a deal, and unfortunately, it didn't make sense for them to move forward. And, sometimes communicating that in a way that helps build trust, which is really important. I've had that happen a couple times before. And frankly, they didn't like the news that I shared. A couple months later, they reached back out with another opportunity, and it was the right one. And they're super successful in multiple locations and have never looked back since. And to this day, this individual has, been very appreciative of my honest feedback for that. I think that's really important. It's all about the long-term play, not the short term. Um, and I think going into that, we look at that from a first acquisition to an expansion opportunity to the purchase of equipment, real estate, et cetera. I think the best banking relationships last decade, not just with one loan. As we get to know each other more, it's all about relationships for me. I like to think I'm a people person. You got to work with people that you trust, and relationships. Trust is always earned. It's never given. And you got to work with people that you trust.
You're definitely a people person, Andrew, and we do know that business relationships can hit a rough patch. And you had a great example that you gave that you did have to deliver some unfortunate information, but things did turn around. What is the most common reason a financing relationship could go wrong?
Real simple, a lack of communication. Businesses will hit bumps, right? It's uncommon. There'll be something that pops up when you're a business owner. Maybe you feel like several bumps at the same time, right? When it rains, it pours. Uh, Problems usually happen when the lender learns about the issues too late, right? There have been countless examples of which I've stepped back in to help our existing borrowers with the challenge that they've had. But we can't help if we don't know what the problem is. So don't be afraid to communicate. Again, over communicate, never under communicate. Um, Communicate early and often is always better.
As we wrap up, I want to leave our listeners with something that they can carry forward. What is the one piece of advice that you would give every funeral home or cemetery owner about capital and growth?
So I'd categorize that into three specific items to hopefully take home. If you only take home three things, hopefully it's these three. First, cash flow is king. Most lenders are cash flow focused. Most business owners, when looking at opportunities, want to make sure that they're buying good, sufficient, strong cash flow. That's really important. Cash flow, cash flow, cash flow. Second, relationships matter. We've talked about that at length during our time together today, Lacey, but working with lenders, consultants, accountants who understand our industry is important. Work with people you trust, work with people that you feel comfortable with and have experience and industry expertise. And then prepare early. The best time to start talking with the lender is before you're under a deadline. It's much more fun. It's a better process. It's a better experience for all involved when you can have your time in doing such and making sure everything's done correctly and the right way versus trying to operate under a hard deadline. And there's no such thing as preparing too early, and that goes for the buyers and the sellers. I can't emphasize that enough. Um, the owners who have the most options are the ones who typically plan ahead. They know their numbers, they invest in their business, and they surround themselves with the right and trusted advisors.
Excellent, Andrew. I want to check in with Maddie and see if we have any questions that have come through on the chat.
Well, looks like y'all left. Oh, hang on here. Let's see. Okay, two just came through. Good timing. What kind of EBITDA multiplier range does Live Oak consider to be bankable? At what multiple range do red flags start being waved for the average small business buyer?
Great question. So I would say I'd answer that in terms of what the cash flow typically supports. So when looking at an opportunity, typically the cash flow will support anywhere from a 5.5 to 7x multiple of EBITDA. Again, that number could vary depending on what's included, meaning, the real estate figure. But typically cash flow is supported by a 5.5 to 7x multiple. Businesses that are closer to, say, a 40% profit or net operating margin which is very good in this industry, is likely going to see closer to a 7x multiple. Whereas if there's a business that's operating after adjustments in the teens, which is probably below average in our industry, you're likely going to see maybe closer to a 5.5 to 6x range. But, in summary, I would say that most small businesses, the debt can be supported on a 5.5 to 7x multiple.
All righty, let's see here. Hope you got that, William. Both Lacey and I are like, yes, aha. All right, so let's see here. We got another person who asks, do you lend to asset-light businesses like direct cremation? And if so, how is your approach different from lending to funeral homes that have actual assets?
Yes, we do. We do. We lend to funeral homes, cemeteries, and like-minded businesses. Each is a little bit different. So we learn about that if we don't have knowledge, but we've financed many of those deals before in the past. And at the end of the day, as I mentioned before, it really comes down to cash flow, right? Is what you're buying able to service the debt, cover all expenses, afford a salary for you, and still be in the green or the black, the profit, essentially. That's really important. But yes, we finance more than just funeral homes and cemeteries, mortuaries, direct cremations, all of the above.
All right, hey. So yes, there you go, Kate. And then let's see here, Victor, what do you see as standard for seller financing in the industry as percentage of purchase price?
Really good question. And my friends at JCG would probably be better equipped to answer that. But I would say that it's common for there to be some part of seller financing, especially if there's an equity requirement for that first-time buyer. It's often that they will help their buyer meet the 10% requirement by holding a 5% seller note subordinate to the bank debt. But there's also been a handful of transactions just this year where it's been a 50-50 split between cash up front from a bank and 50% seller financing. Again, I think it's important to meet with your team to evaluate the differences for what the short-term, benefits are and what the long-term benefits are that. But it's very common for there to be a component of seller financing coupled with bank financing. It could be just one or the other, but oftentimes there's a form of both.
Awesome. Well, thank you, Andrew. It appears that was the last question. So thank you
Thank
very
you,
much.
Maddie. Andrew, this has been such a valuable conversation. Thank you for sharing your expertise on Johnson Consulting Conversations. And please share your contact information if anyone would like to speak with you directly.
Thanks, Lacey. And thanks again, Maddie. This has been great. Appreciate you guys having me on. So I'll give you my cell phone number. That's always the best way to reach me. And that's 336-671-0089. Again, that's my cell phone number. And then my email address is also a great option. And that is andrew.kennedy. So my first and last name with a dot in between it, andrew.kennedy at liveoak.bank. Not .com, .bank. Andrew.Kennedy at liveoak.bank.
Thank you, Andrew. And that is .bank. I got that. Thank you for that. Before we go, I want to make sure that everyone knows about Cana's Certified Hospice Relations Specialist Workshop that's happening on August the 12th in Minneapolis ahead of the Cana Convention. I'll be facilitating that workshop, and Johnson Consulting Group is proud to sponsor this exclusive Cana training. If you register, use the promo code with Lacey for a discounted registration fee. And I want you to mark your calendars for August the 19th at 2 p.m. Eastern Standard Time for our next Johnson Consulting Conversations, where you don't want to miss it because I'll be joined by Savannah Eneboff, and she is the social media director for Ring Marketing. And to everyone that joined us today, thank you, and we'll see you next time on Johnson Consulting Conversations. Thanks, Maddie and Andrew.